here for debt, where W sub D now it's still a weight. It's the portion of the firm's capital it expects to raise with debt, right? So it's the weight of debt. And R sub D is going to be the expected return on the firm's debt, and that is the firm's yield to maturity, or YTM. And then finally, we got this one extra term here on debt, 1 minus T sub C, right? Where T sub C is the firm's marginal tax rate. Now with debt, what we have is we have tax savings from the interest payments on debt. So those coupon payments that debt makes, that's interest that they're paying on borrowed money, and the firm will actually get to deduct those from taxable earnings before it calculates its tax payment. So debt offers an actual tax shield. And so the yield to maturity, if you remember from the bonds chapter, is the rate of return that bondholders expect to earn if they were to buy the debt and hold it to maturity and receive all the coupon payments and reinvest them at the yield to maturity. So this is the yield to maturity is the rate of return on debt. But from the firm's perspective, since it gets to deduct those coupon payments, there's actually a tax savings there, and it doesn't quite have to earn the full yield to maturity to be able to pay the coupon payments, because they will have some very real tax savings from those. So that's why that 1 minus T sub C component is in there. Okay, now let's see what we've actually got here and what we're going to need to calculate. A lot of this stuff we've already been given in the problem. W sub P is the weight in preferred equity. And we've been told in this last sentence that the firm's target capital structure is 60% common equity. All right, so W sub E is our common equity. That term is going to be 0.6. We already know that one. No calculation required. 5% is going to be preferred stock. So W sub P is going to be 0.05. No calculation needed again. And then the weight in debt, or W sub D, is going to be 0.35. Okay, so no calculation needed there. We've got some other bits of information. We know the firm's yield to maturity is 6%, so we already know the cost of debt at 0.06. And then we also know the firm's marginal tax rate of 40%. Okay, so we know T sub C is 0.4. So it turns out there are only two terms we need to calculate here because we weren't given them directly, and that is the cost of preferred equity and the cost of common equity. Now these are going to be not new calculations. We already learned how to do these in the previous stock chapter. We're just going to reuse some of that knowledge. So we'll take these in order. Let's start with the preferred stock. All right, the information we have on the preferred stock is that it is currently trading for $50 and pays an annual dividend of $5. Right? And if you recall from the stock chapter, preferred stock, we're looking at it as a perpetuity. So if you as an investor were to buy a share of preferred stock in this company for $50 today, you would earn a dividend of $5 per year forever. It just goes on forever. So preferred stock is nothing more than a perpetuity. So if we want to know the implied rate of return on that, we can just take equation 4.03, the present value of a perpetuity, and plug in the current price as the present value, cash flow next period as the dividend we would expect to receive, and then we can solve for R. All right, so that will look like this. The present value is 50. Cash flow next period is $5. And if we divide that $5 by R, we should get the present value of $50. Or another way of thinking about it is, what is the implied rate of return here if we were to pay $50 today and then start receiving a dividend of $5 every year? So algebraically, we're just going to solve for R here. We're going to multiply both sides by R. Right, so we've got an R in the denominator on the right-hand side and an R in the numerator on the right-hand side. So those guys are going to cancel out. We're left with R times 50 is equal to $5. Well, I've got R over here on the left. We need to get it by itself, so we're going to divide both sides by 50. So on the left-hand side now, the 50s will cancel out, and we are left with just R equals 5 divided by 50. And that turns out if you're to plug it into the calculator, you're going to get 0.10 or 10%. Right? And we didn't label that, so let me go back just so, because we're going to have to keep track of multiple costs here. That's actually our R sub P, or our cost of preferred equity, is 10%. So if we want to plug that into our WACC equation, just to keep track of what we do and do not have, that R sub P is 0.1. So now we're left with just the cost of common equity. And if you recall, from the stock chapter, we were actually given two different ways to calculate the cost of common equity. We have the dividend discount model, and then we have the capital asset pricing model, and which one we used just depended on what information we were given in the problem. If we're given information on the current price, the expected future dividends, we're going to be using the dividend discount model. If we are given information instead on beta, expected return on the market, or market risk premium, and the risk-free rate, then we know we're going to be using the capital asset pricing model. And if we look at this particular problem on the section about common equity, we see that we estimate the firm's common equity beta at 1.7, the expected return on the market at 9%, and the risk-free rate of 2%. So we know, given that information, that we're going to be using the capital asset pricing model to calculate the cost of common equity. All right, and that is given by equation 7.5, where we've got the generic term R sub I. I'm actually going to relabel that R sub E, because in this case we're using it to calculate the cost of common equity that we're going to plug into the capital asset pricing, we're going to plug into the weighted average cost of capital formula. But it turns out to be the same thing. R sub I is just the required return on some generic stock I. We're just using I for some individual asset. In this case specifically, we want the cost of common equity for the WACC, so I'm just going to change that variable there to keep track of it. RF is the risk-free rate. That was given to us in the problem at 2%. The beta, I believe, was 1.7. Let me peek back up. Yep, beta 1.7. And then the expected return on the market was 9. And we subtract off our risk-free rate again of 2%. So R sub E is going to be equal to that 2% plus our beta of 1.7 times 0.09 minus 0.02 is going to be 0.07. All right. And let me just double check that beta really was 1.7. Yes. Okay. All right, so let's plug that in and see what we get back. 0.02 plus 1.7 times 0.07 gives us 0.139 or 13.9%. All right, so that is our cost of common equity. And just to keep track of it, I'm going to put it up here. All right, so now we have all 1, 2, 3, 4, 5, 6, 7 terms in the weighted average cost of capital equation. We can just drop it in. To the equation and see what we get out of it. Right, so our WACC in this case, our weight and preferred stock was 5% or 0.05. We're going to multiply that times R sub P, which is the cost of preferred stock. And we calculated that in the previous step at 10%. We're going to add to that the weight in common equity, which I have already forgotten, was 60%. Yep, 60% common equity. Okay, so 0.6 times the cost of common equity. We just calculated that at 13.9%. And then finally, we're going to add to that the weight in debt, which was 35% given in the problem, multiplied times R sub D, the required return on debt, which is the yield to maturity. That was also 6%. And we've got to multiply that whole term times 1 minus the marginal tax rate, which is given to us at 40%. All right, now when I'm working these long terms, at least if I'm using the BA2+, what I like to do is just work it one section at a time and then store the values and then add them up at the very end. So I'm just going to work left to right. Say 0.05 times 0.1. Could probably do that in your head, just move the decimal one place there. So the portion of the cost of capital coming from preferred stock is 0.005. I'm actually going to store that on the 1 key so I can go back and add it to the other two terms without having to type it in again. All right, now I'll go after the second term. 0.6 times 0.139. Okay, so 0.0834 is the portion of the cost of capital coming from common equity. I'm going to store that on the 2 key. All right, and then finally this third term. 0.35 times 0.06 times, now I can either have the calculator do this subtraction for me. If I do, I'm going to want to put it in parentheses so that it does the subtraction first before the multiplication, or you could just do it in your head. 1 minus 0.4 is going to be 0.6, but just for the sake of showing it, I'm going to have the calculator do the subtraction here. So I'm going to say times, open parentheses, 1 minus 0.4, close parentheses, and notice it went ahead and did that subtraction for me, and then I can press equals. It'll multiply those together. For 0.0126, and I'll store that on the 3 key. All right, now I want to add those 3 terms together to get my overall weighted average cost of capital. So third term's already on there, so while it's on the screen, I'm just going to hit plus recall 2 to get the common equity, and then plus recall 1 to get the preferred equity. And it adds all those together for a total weighted average cost of capital of 0.1010, or 10.1%. And that was what the problem was finally asking for. Okay, a couple of things worth noting if you're still hanging on to the video beyond just how to calculate it. One is this is a good time to do a gut check. A weighted average is nothing more than an average where things are just not equally weighted, but it's still the same concept of an average holds. Right? The number that you come back with should not be higher than the highest return that you plugged in, and it should not be lower than the lowest return you plugged in. Our returns in this case ranged from a high of 13.9%, which made up the majority of our weighted average cost of capital at 6%, down to a low of 6%, or really 3.6% if we consider the tax consequence there, 0.06 times 0.6. So the number that we get back should be in between 3.6% and 13.9%, and should probably be closer to that 13.9% since more weight was there, and then we also had 5% at 10% there. And sure enough, the number we're getting back is kind of in between those. That's about what we would expect. You would know if you got a number back, for example, that was something like 15%. Well, your highest input in this weighted average cost of capital equation was 13.9, so if you're getting something back higher than that, you know something's wrong. And likewise, if we got something back lower than, say, 3.6%, we would know something was off. Okay, here's the other thing about weighted average cost of capital that will come into play in later problems. This one was very carefully constructed so that there is no extra information in it or no information that you shouldn't use. The weighted average cost of capital is going to be used to evaluate investment decisions for money that we're going to invest today, and then it's going to pay out over a project's life. And a lot of these projects are going to be long-term projects. So what we need is a forward-looking rate, the rate that we think our financial stakeholders are going to demand over the life of this project. So when we plug in the required rates of return for preferred stock, common stock, and debt, it needs to be the current yield to maturity on debt, or what investors are currently demanding. It needs to be the expected rate of return on common equity and the expected rate of return on preferred equity, right? So those forward-looking market-based rates. The same applies for the weights of those sources of capital. What we don't want to do is look at our book values, so pull our accounting books or our tax returns and say, and pull our capital structure from there, unless that's the exact capital structure we think is going to apply over the life of this project. Firms will change capital structure. That is, capital structure refers to the firm's mix of debt and equity. That will move over time as the firm takes out more debt because interest rates are favorable, right? So maybe they put on a little more debt than they might otherwise want to have. But as that debt matures, they'll move back towards what we call a target capital structure of a mix of debt and equity. So we want to use for the weights and the returns those forward-looking market-based values instead of pulling it from backwards-looking historical accounting records. Right? And some problems will throw sort of book values at you, and you'll know that if you're calculating WACC, you've got to ignore those, and you want to use the market rates instead.